Okay, good morning, everybody, and welcome to my little daily SPX daily plan show and review of the markets and kind of whatever else seems to be relevant at this time. Okay, quick review of yesterday. Let me just get this plugged in here. Okay, I can't find the plug. Okay, so as most of you know, we had a big rally yesterday, about 1.5%, which was the biggest one day move we had since May. Now, we also know that there's been a lot of volatility selling, and realized volatility has been kind of tight. And so we had those two big sell offs last week on Thursday and Friday. Here they are. And now we have and then we had the rally yesterday. Yesterday we opened at 62.70, so that's kind of a line in the sand or a number to remember. And we closed right below 60.30, which we talked about in pinball yesterday live on YouTube. That was right where there was a huge market maker positive gamma strike. And TLDR, we don't close or rarely on a strike where market makers are long gamma, customers are short. But if it's big enough, we mean revert right back up to it and close right below it, which is what happened yesterday. Um, a quick word about what's going on in the volatility space. I don't have all the numbers and stats in front of me, but again, short version of the story. Last week on Tuesday, it started a little bit. Wednesday, more so. Thursday, more so. Friday, more so. We saw volatility starting to catch a bit. The first place you usually see it is in VVIX. VVIX is the volatility of volatility. Just think of it as the VIX of VIX. Same calculations that CBOE uses to calculate the VIX, same formulas, strips of VIX options out, whatever the dates are, 28 to 30 something, whatever there's kind of a range of dates that they use, weighted however they weight it. And VVIX had been really low. If you look at where it is down here, it was like 85, 80, below 90. And so there was no demand for VIX. And VIX was down here. Where's VIX over here? VIX was down near 15 below. So we had all that happening. We first saw it in VVIX, and we also saw in nations indexes. Um, First, we saw it in TDEX, which is three standard deviations out of the money SPY puts 30 days out. So there was demand for tails more than there was demand for. This was up about 18%. The skew index, which was one standard deviation out of the money, your kind of standard out of the money um, convex play, was up about 8% versus 18% on TDEX. Vol I, which is the at the money vol, went up kind of like VIX did, nothing crazy. And so the obvious takeaway is people are buying tail risk hedges, some out of the money stuff. And yesterday we ended up with a totally put dominated structure in the SPX. We weren't in backwardation, but we were kind of close. The VIX 9 day and the regular VIX and the VIX 3 month are all kind of clumped together in a flattish looking term structure. And as kind of expected, VIX went down, and we got a McMillan VIX buy signal. So let's talk about that. Now, McMillan, Larry McMillan, I call him the OG of options. It was his book that I read in the late '90s, early 2000s, when that was pretty much, as far as I knew, the only game in town. And he has and he's on Twitter. I tag him all the time. He has his McMillan VIX Spike Peak buy signal. Let's find it. Is this right? Here we are. Where's my whale thing? What happened here? Something got screwed up here. There it is. Okay. He had his spike peak buy signal. And let me just show you that real quick. And so what his spike peak buy signal is, and he's been using this for 25 years that I know of. Um, when VIX goes down 3 points, real simple, from a local high, which was 21.9 high on Friday. So 17.9 below 18 close is a buy signal. Signal lasts 22 days. According to him, you buy at the money call in SPY, usually 30 days to expiration. Sell usually a 15-point out of the money call. Sometimes he does them a little wider, 15 points out of the money call, and that's it. That said, he also noted that there's been mixed signals because there was also 3 caution signals last week as well. So, but he trades each signal independently. He could have a bull and a bear position on the same time. So anyway, uh, he does it from close to close. So from intraday peak to whatever day's close it is. Good question. Good question. So according to his rules, whatever the peak was, and that could be intraday, if we close 3 points below that peak, the signal is good, and the signal is invalidated if we close above the peak. Okay, never mind. So anyway, so that's the VIX spike by. Okay, so that said, let's get on with the daily plan. Okay, we had some kind of numbers, trade deficit, China. I don't know. I have it in my note, ISM maybe, or services, whatever it is. I don't really worry that much about the numbers themselves. I leave that to the macro bros. Let's just see what the market reaction is. And it looks like the market reaction wasn't great. Trump was just on CNBC, and the market really didn't do much of anything, which is kind of unusual. Now we have the IC whale today, and I'll show you where he is in a minute. So those of you who see the IC whale, see the IC whale has a small hedge fund, and he also has some other trading services or whatever. And he sells iron condors 5 wide and 10 wide, roughly at the 20 delta standard deviation of the move after an outside move, after an outside day, a day where IV, where realized volatility exceeds implied volatility. And it's mechanical, and so he sold them, and he has some 5 wide and some 10 wide. Over here, 62.95, 90 and 62.95, 85 on the bottom, and 63.60, 60 and 63.65 on top. See, I got it right there. Okay. All right. You're welcome. Okay. Yeah, yeah. Okay. Uh, as the wolf on Pulp Fiction says, I talk fast, I think fast, and I'll add, so you have to listen fast. Everybody has to listen fast. Okay, and so the IC sold it. We have about 10,000 contracts here, which is basically framing the day. Let's take a look at that, and then we'll go on to some other stuff. Oh, before that, I put the link in here, and I'm going to put it in again in case you weren't paying attention. Wait, let me find it here. It's over here. So Scott Nations, the founder of, developer of Nations Indexes, is going to be doing a live webinar podcast. I don't know what the proper millennial term is. I guess someone could let me know. With me tomorrow at noon, Wednesday at noon, on Twitter and on YouTube, on my channels, on my Twitter and on. Hopefully, he'll also do it on his as well. I would think, but we'll see. Um, and we're just going to talk about the market volatility. I don't really have a strict format yet, but I certainly have some questions for him. And so that's very gracious of him to kind of do something with a small potatoes retail guy. I did do a little semi-beta stuff for him. He's launching a website for retail, quote unquote. He has institutional products. Um, and he's just got to get the tech kinks out of it. I haven't seen it for a few months. Last time I saw it, there was some kinks in it. And so tomorrow I'll ask him, or maybe today I'll ask him so I can get in there and take a peek at it so I can ask him some questions about it that some of you might have. Okay, moving on. Next thing, what do I got here? Okay, so here's the IC whale. 10,000 contracts sold at 63.55. So in theory, we shouldn't get over it. We could. We often see it get overrun. But we don't know. We don't know. So he sold, I could get overrun on either side. So he sold the 63.55, the 62.95. Think round numbers, 62.50, 6,300. Why do I say that? Other than it's easier to think of. And again, gamma hedging 101. Yeah, they're very close to the money. Very, very close to the money. I notice he tends to sell his calls a little closer. I'm going to speculate that he has a certain premium that he's trying to get, a little more, usually a little more than a third the width of the spread, almost $2 on a 5 wide. And since we have put call skew where the puts are put premium and put pricing is more expensive than call pricing, I think he rolls his calls a little closer to get his premium. Would I do that? No. But that's how he does it. I'm pretty sure. So yeah, his calls are really close. And so basically we have a pretty clean structure. Not much going on between where we close, 63.30. And so Gamma hedging 101. As you move up to a market maker long strike, the market maker sells, and so that's why I say 50, because you're not going to hit that strike in theory. You're going to get up toward it, then you're going to mean revert back down. It goes against the direction of the move. So as you go up, there's going to be selling, but then as you move away, there's going to be buying, making it sticky. And so we have this zone where we should, as we go down, these guys are buying for this, and then they're buying for this, and as we move away, they start selling. So we have this zone here. If below 63.30.25, if we're red on the day, then not a lot to stop it. We got these little magnets even pulling us down, but they're small. Nothing much to stop us until 62.95. But like I said, the hedging will happen before that. So 63.05, 6300. So you have lower chop zone, upper chop zone, bounce around in there. Look for the mean reversion and the flows. Now, what happens? You could this could not easily, but we can get caught in this 95, 90, 85 mess and then come back above it. But usually if we get down here, we tend to break. Or if we get up here, we tend to break historically. Especially we have to see what IV does. And then if we break, let's just say, I'll just use the downside as an example, likely head down towards 75, 70 round number, and then mean revert back toward that long strike. I've seen it often where we break through, pull back, and then we usually close when that happens right either right inside or right outside the long strike. He gets skewered and then he comes back tomorrow with more contracts. And so, yes, it looks close. And that said, many of you might know me for science. I put on similar trades. I'm not quite the cowboy. So let's look at what his trade would be now. So here I actually sold the 55s, but I did it in the form of a butterfly. And I sold the 70s on top of it, not being quite so crazy. So these were a 20 delta yesterday. Now they're a 29 delta. See, that's how he gets screwed. And the puts that he sold, the 95s, and so I also did like a fly structure down here. This is an asymmetrical fly, 132, for a credit. So what's his? So let's just look at what the premium is now. On his 5 wide. So if he closed it right this second, which he doesn't, he'd be a little profitable because of the puts. He got around $2. I don't remember exactly. He got around $2. What I do is trades. I don't leave them on. I close pieces of them. Usually I close each side separately because S&P moves around and you can close each side separately. So I don't usually close my iron condors as one trade. A lot of people do. For science, if I do 2 or 3 of them, I might put in one at 50% buyback and then one each side separately do the buyback, and then we see what happens from there. If I were putting on a new trade right now, first we'll talk about iron condor, then we might talk about flies or scalps. Scalps, it's hard to model out a scalp because it depends where we are. But we can look at a chart and see. So if I were to put a trade on right now, I like going far and wide. 50 cents, that looks beautiful for all the way up here. And on the bottom, there's really not much. 90 cents for that down there. Okay, at the bottom, you can get pretty far away. You can get 60, 40 for the 45 or 50 cents. I would go somewhere like that. 5 or 6 delta, whatever. But I'm not looking at delta. I could give to whatever about delta. I mean, I look at it a little bit. I'm looking where the levels are. And if there's breaks, 75 kind of might come into play. Not that I'm expecting it to happen. 70. So I want to be below that, even though we probably mean revert back up to it. On top, if there's breaks, okay, we're supposed to stall here, but I want to kind of be far away from that. Let me adjust this a little bit. Let's just see what's going on up at 6,400. As expected, we have sellers up here. We have some sellers over here at 75, so we don't expect it to get through there, but we could get some chop move into here should it break for whatever reason. Not saying it will. Good morning, Just Flow. That's what we're talking about. We're talking about flow. We're talking about flow. And speaking of flow, so reading the gurus, I read mixed things about CTAs. Some say, I guess happen to have this guru here on hand. Where is it? Where does he have his systematic? Okay. So he has, this particular guy has systematics, CTAs, commodity trend advisors, trend following, kind of up near the top of their range. I think Mentor Q does, a lot of other people do. They're kind of maxed out. Volatility control funds, which base their allocation based on realized vol versus implied vol. This doesn't want to seem to be loading. Well, there it is. Well, they took some off after the selling on Friday and Thursday. So, but they're also near the top. Others say that there's still going to be some buying here, but most everybody has. Okay, so projected positioning, upside scenario. If we keep going up, there's going to be this much of a change, a little bit of buying up if we go up past 6,400. Ooh, CoreWeave merger offer. Wow, look at that. Interesting. Downside scenario, if we go down, I'm not sure how to read this. I guess that's some billions or something. I don't know. That doesn't make sense. But I think I saw Goldman or Morgan or one of them said really 10% down is going to be the trigger for big for big selling. But as far as flows go, we have corporate buyback season kicking in. However, that always happens in August, and we've been known to have shitty August, technical term. despite those flows. Those flows aren't enough to avert a disaster, but they might mute one, or if we're just kind of shopping around, it'll be a bit of a tailwind. You think market makers would prefer pushing toward? They seem natural. Market makers don't prefer anything. It's a myth that market makers try to steer the market or whatever it is. They're just mechanical, whatever their program, whatever the risk manager says. Um, they would prefer not to do anything. They would prefer that nothing moves and everything just, and they keep the premium. Um, that said, okay, so do you think mom would prefer pushing price towards, since they're not long there? They seem net short in between. No, in between, they're not net short. Okay, first of all, market makers don't try to steer the market at all. That's not a thing. And if you want, Valsigs has a detailed post about it. Vol Signals is his Twitter handle. I'll put it in there later. He's a retired market maker. He trained market makers. Market makers don't steer. They react to price. They don't. And if you look over here, market makers are long, market makers are long, market makers are long. Now, yes, when market makers are long, they get to sell some of their inventory, and so they make money. Sure, they prefer to make money. That's what they're in business for. When we get to where they're short, then they have to chase, and they're competing with you for the bid rather than making it. So hope that answered your question. I didn't mean to be a smartass, but and let me just find this for everybody. Valsigs, my man. Here we go. Market makers don't manipulate price. Okay, I'm going to put this in. If you're in the gamma space and you're going to follow someone, he's a great follow. While I'm in the neighborhood, Nations Index, Scott Nations, he and I are going to be doing a thing. Put that in. And so, actually, let's go over this as a community for a second, just because a lot of people watching kind of think this. Market makers don't manipulate price. They're trapped by their own hedging requirements. When price drifts between short and long legs, our system starts buying and selling futures that create predictable path. And it gives you the formula. Gamma, spot movement, charm, passage of time, vantage, change, implied volatility, position size, and position type. That's what the factors that go into the model. Change in delta and change in spot, that's gamma. If market makers are short options, we're short gamma. Our delta gets shorter as the market rallies, longer as it declines. Long gamma position means we're stabilizing the market. We add size on both the bid and the offer. That keeps price contained. Short gamma position means the opposite. Not only do we pull quotes from the underlying bid ask, they take their quotes away. We actively sell into declines and buy into rallies. No matter what else is going on, that's charm, the clock is ticking. Okay. The distribution collapses around those strikes. This process is nonlinear, complex, and variable in practice. Incredibly important to understand why. It creates directional influence. Okay. So they start off neutral. Eventually, we're simply long the straddle. But where is it where he addresses that we don't manipulate? We drop implied vol, whatever it is. Okay, so it's a pretty long tweet. He has another one where he does something similar. So just thought I'd put that out there. Good morning, Selena. You're welcome, Just Flows. And it looks like I got an email from Scott Nations about, okay. So here's where we are. Let's take a quick peek at a different view of the same thing. Whoops, that's the same view of the same thing. Maybe I got it here. Here we go, table view. So here we are. There's 10,000 short contracts here, and there's 7 and 3. Why? Because some were done 10 wide, some were done 5 wide. Between 55 and 30, kind of where we closed, where we are, market makers are short some, so there's kind of a pull of the path down towards 30. 30, 25, there's a little bit of market maker long, it's green. So there's kind of some choppy action in here. If we get below here, again, not much in size, but 63.10 is the biggest number. So we could pull toward there. And then the stabilizing forces of this, remember they're going opposite the direction of the move. The stabilizing forces of this should push us back toward here. If this breaks, there's really nothing down to 50. Not saying we go there, but there's nothing from a market maker gamma hedging position that requires big adjustments. Typically what happens, I'll just use this example, if we break one of these big long strikes, his or anyone else's, but I'll just talk about him, we tend to go wherever we go and pull back toward that strike. We tend to pull back. We tend to pull toward market maker short strikes. Same thing on top. On top, the picture is a little cleaner. If we break above the 65, we have sold options all above it that should stall the move, but keep us bouncing in the zone. And that's about it. Let me see if there's anything else. Let's take a quick peek over here. And so here's where we are. See, I got my cute whales there to show you where they are. This is the little string that I make up based on the plan I write. This string isn't generated by computer program or whatever. It's simply my levels, what I write up in my daily plan, written out caveman style and converted into a trading view string. And that's what I see for today. Not sure, excuse me, how we're going to react. IV. What's VIX going to do? That's the real question. What's IV going to do? I want to take a look at one more thing while we're in the neighborhood. One or two more things, and I'm going to go and listen to Valsig, the guy that I just mentioned. Oh wait, before we do that, see, I keep going before we do that and do something else. Okay, let's go. Let's just stay here. Let's go to market maker's position. Okay. Now this is the whole complex, not just the 0 DTE, but the 0 DTE has an outside weight because gamma is dependent on closeness to spot and time, and so these are obviously the closest in time. And so red is market maker short, a potential magnet, path of least resistance, 50, 50, 47 and a half, 55. Path of least resistance over here, 42. That's later in the day. In the morning, really not much of a pull. End of the day, that 10 that I mentioned, and I hadn't looked at this before, would kind of be what we would pull toward. Would kind of be what we would pull toward. Let's look at Charm. And Charm is going to be pretty clear cut, at least for now. What is it? The short strikes push us down. So we would be right below, in theory, right below or right above this structure, or in that 63.30 gap, or below that 95.90 zone. And we'll play pinball live at 3:30 on YouTube. Uh, one more thing while I'm at it. Oh, hi Flyer, how you doing, man? One more thing while I'm at it. I kind of forget the quote unquote, I don't know what you want to call it. I forget to put all the links and stuff in. That's in theory I'm supposed to put in. And so let me just find my links. Okay, here's my little pinball link. Here's my Substack link. And I got a discount code if anybody is interested. For options depth, that's the platform I was just showing you before. I have a discount link for Mentor Q, which I'll show you in a second. And I'm still waiting on links from other people. And that's about it. One last look at TradingView. Let me show you Mentor Q real quick. One of the things I like about their product is I like this heat map feature, which kind of shows you the zones. And they also have an intraday update. So those are the intraday zones. So it gives you a clear idea of what the direction might be. So here you see the next directional move is down here in this 20 area. So before the calls were in jeopardy, now suddenly that's changed. Let me go back to showing my thing because I want to look at my work. I derived it. I wrote it. I figured it out. I trust my work. I did my work. Not that I don't trust them, but I trust myself. Okay, now I'm really going off. Have a great day, everybody. See you for pinball.